I'm Justin Boyd, President of Delta Financial Advisory, a registered investment advisor. We provide wealth management and investment advisory services grounded in unbiased analysis of the economic landscape and financial markets, combined with a holistic approach to financial planning. Welcome to our monthly market update video series. We'll review the prior month's economic and market data and provide our thoughts and outlook going forward. If you'd like to learn more about Delta Advisory, please visit our homepage at deltafinancialadvisory.com and complete the contact request form. If you find value in today's content, please like this video by clicking the thumbs up icon and consider subscribing to our channel. Okay, let's get started. Equity, fixed income, and commodity markets experienced continued and sizable volatility last month, following a large amount of economic and political inputs. Ultimately, we view market activity during February as an acceleration of our continuation theme expressed in last month's market update, particularly as it relates to the decline in bond yields and the continued pressure on oil prices. With so much information and events occurring this past month, we'll focus our update today on inputs that are known and tangible, and save more fluid developments, such as a sovereign wealth fund, for a future date when or if they materialize. In our view, the following items are some of the most critical considerations from February for investors. First, the S&P 500 was down, Treasury yields were down, gold was down, and Bitcoin was down materially. Ultimately, it's our view that markets are clearly speaking now to larger economic and liquidity conditions. Second, GDP experienced a continued deterioration in the quality of growth as durable goods and investment spending declined, while consumer spending increased against a backdrop of declining real wages. Government spending was flat, but still robust in terms of tax revenues and national accounts. Ultimately, nominal GDP remained flat, while real economic growth contracted. This is something that we will continue to monitor closely, as the potential for stagflation is ever present. Third, equity markets remain elevated due to growth expectations and a forward multiple relationship that is only sustainable if intermediate and longer-term earnings per share growth remain materially elevated versus history. Given many of the factors we'll discuss in our update today, we find this increasingly challenging to support for any investment portfolios where capital preservation is an input. Department of Government efficiency efforts continue, and a reasonable execution of these efforts, emphasis on reasonable, should provide benefit over the medium and longer term. However, in our view, fiscal dominance remains a critical driver of the larger economic landscape for some time to come. Lastly, we do have some expectation of future FOMC policy and monetary accommodation. However, this is easily offset in the shorter term by unknown impacts of geopolitical and tariff policies, weaker real economic growth, and even some potential for residual lag effect from moderation of COVID-era policies. Headline real gross domestic product declined to 2.3% on an annualized quarterly basis. Our preferred metric on a year-over-year basis showed the economy continued expansion at a 5% nominal rate, with the real growth component contributing exactly half of that amount at 2.5%. Continuing in tandem with nominal GDP growth, we saw headline CPI increase at 3% year over year, while nominal hourly wages increased 4.1%. Directly related, it's also noteworthy that money supply and bank credit continue to expand at about 4% annually. While this growth rate remains below long-term trends, we view this as at least marginally supportive of financial markets going forward. However, though it may come as a surprise, we would draw attention to the true trough in monetary accommodation during the COVID economic cycle as the first quarter of 2024. It's our view that contractionary lag effects still remain a possibility in the near term. While we're not suggesting an expectation of asset price declines related to lags in monetary policy, we certainly would suggest that when combined with other real-time inputs, this does present a possibility of downside volatility for equity and other risk assets. The beginning of this trend very well may have presented itself in February, as evidenced by the downward bias in equity indexes and a material decline in the most sensitive, risk-on, liquidity-driven products, Bitcoin and XRP. There are a few additional inputs that we think deserve specific mention this month. First, various inflation metrics, particularly shelter costs, suggest the possibility of a temporary dislocation in agency-reported numbers versus real-time market and economic inputs. Zillow and Redfin both continue to report virtually flatline rental cost increases, while the most current CPI report states 4.4% year-over-year shelter cost increases, with an annualized monthly rate exceeding 4.4%. While we acknowledge a known lag of government-reported rent data versus more volatile and near-term measures of private entities, such as Zillow and Redfin, this large of a spread gives us pause, particularly on the backdrop of a slowing economy, at least in real terms. Put another way, we suggest that headline CPI may also be overstated at present. This is supported by the most recent Truflation data, which shows a 1.5% year-over-year change. I'm not suggesting the Bureau of Labor Statistics is purposely misstating numbers or performing inferior professional work, but rather suggesting that more nimble and real-time measures of economic activity may serve investors well for the foreseeable future. Second, the most recent Q1 2025 GDP Now estimate from the Atlanta Fed shows a growth rate of negative 1.5%. This is down markedly from positive 2.3% reported just a couple weeks earlier. This tool is known for volatility, as it is the leading edge of GDP estimates, so this could certainly swing back to positive territory over the weeks to come, particularly as certain inputs moderate or are adjusted by the official release date. However, this large of a negative revision in a compressed time frame most certainly caught our attention and could be a warning for future growth. Lastly, the U.S. continues to experience abysmal trade balance figures, as well as deficit figures. While we won't analyze specific numbers here today, suffice to say that until or unless the new administration is successful with their concerted and warranted efforts to correct these imbalances, continued inflationary pressures are likely set against a backdrop of potential slowing growth. This would almost certainly place continued pressure on equity markets and could also materially impact fixed income markets, depending on the exact mix of real and nominal figures. For those interested in a more detailed analysis of the U.S. fiscal situation, our video entitled Inputs to Sustainability, a review of U.S. budget constraints, found here on our channel, will provide additional insight. What's the ultimate impact going forward for investors? We continue to view current cap-weighted valuations of all major equity indexes as elevated, particularly given that the current valuations are largely based on future growth expectations that are well above historical averages. We would also note that should the most recent emergence of slowing international capital flows continue, this would present headwinds to current market pricing and could present much more significant selling pressure in the future. Implications on the US dollar and the impact on longer-term goals stated by the current presidential administration should also be considered under this scenario. A major aspect of our portfolio management and investment philosophy here at Delta Financial Advisory is maintaining focus on true economic drivers and the implications of those drivers in the intermediate term, while evaluating near-term inputs for material impacts, but never losing sight of the long-term destination for our clients. In keeping with this fundamental driver of our investment approach, we maintain our asset allocation from last month of a moderate underweight of equity, as well as a moderate underweight of duration in our fixed income allocation. Should economic conditions take a material downturn, we could leave some fixed income gains on the table from a likely decline in rates. However, given the larger backdrop of fiscal dominance and the associated concerns toward the long end of the yield curve, we're content to take what gains may come from a moderate underweight of duration relative to fixed income benchmarks, but have a higher likelihood of protecting client capital and purchasing power against more extreme outcomes. On the equity side, due to a moderate underweight relative to target risk profiles, we view any upside left on the table from near-term price increases as minimal in risk-adjusted terms relative to the possible loss should equity markets truly correct to more attractive levels for long-term fundamental investors. Thank you for watching, and I hope you gained value from this video. You may notice that some detailed information surrounding our specific asset allocation and portfolio holdings are not shared. This is out of respect for our existing clients. Should you like to learn more about Delta Financial Advisory, please visit our homepage at deltafinancialadvisory.com and complete the contact request form. We offer a complimentary consultation to explore if our investment philosophy and portfolio strategies may be a good fit for you.
The information and commentary contained in this video are for general informational purposes only and do not constitute financial, investment, or other professional advice. Always consult with a qualified financial advisor before making any investment decisions. Investments carry risks, including the potential loss of principal. The content is based on current market conditions and is subject to change without notice. The firm is not responsible for any errors or omissions, or for any actions taken based on this information. Past performance is not indicative of future results. This material does not constitute an offer or solicitation to buy or sell any securities.